August 6th, 2024. A date that will be remembered for years to come. A day etched in market history, marked by unprecedented turmoil and chaos. A bloodbath. Carnage. The financial world was in disarray. The S&P 500 plummeted 5.2%. A staggering drop. The Nasdaq down 6.8%. Tech giants were not immune. The Nikkei 225 in Tokyo mirrored the pain, free-falling 6.1%. This wasn't just a blip, it was a seismic event in the financial world. A full-blown market meltdown. Shockwaves through every corner of the economy. The shockwaves were global. Every market felt the tremors. The world watched its financial system teeter on the brink. Efforts to recover were underway, but the road ahead was uncertain. As the sun rose the next day, the world braced for a new chapter, with hope for a brighter future. To understand this crash, we need to rewind. Let's take a closer look at the events that led up to this dramatic downturn. The week leading up to August 6th was a roller coaster, filled with unexpected twists and turns that kept everyone on edge. Monday started strong, a surge of optimism, fueled by, well, nobody seemed to know why. It was as if the market had a mind of its own. Tuesday saw a slight dip, profit-taking maybe. Investors seemed to be cashing in on Monday's gains. Wednesday, the markets held their breath, waiting for the Federal Reserve's interest rate announcement. No change. Relief? Not quite. The lack of movement left many feeling uncertain. Thursday brought confusion, a mixed bag of economic data leaving analysts scratching their heads. And then came Friday, the calm before the storm. The market seemed eerily quiet. The warning signs were there, but nobody wanted to see them. It was easier to ignore the red flags. We were blinded by the bull market's long shadow, still clinging to the hope that the good times would last forever. But in the markets, as in life, what goes up must come down. The bubble was bound to burst, and boy, did it come down hard. The crash was a stark reminder of the market's volatility and the risks inherent in investing. This wasn't the first time the market had experienced such turmoil. History is filled with similar events, each one a lesson in the cyclical nature of financial markets. Analysts and traders alike scrambled to make sense of the chaos, dissecting every piece of data, every trend, in an attempt to predict what would happen next. The debates were intense, with some predicting a quick recovery while others warned of a prolonged downturn. The uncertainty was palpable, and everyone had an opinion. As the dust began to settle, the focus shifted to recovery. Investors and advisors worked tirelessly to navigate the new landscape, seeking opportunities amidst the chaos. History has shown that markets are resilient. Despite the crashes and downturns, they have always found a way to bounce back, driven by innovation, growth, and human ingenuity. And so, as we look back on that tumultuous week, we are reminded of the market's inherent volatility, but also its capacity for recovery and growth. The journey is never smooth, but it is always forward. New Black Monday. That's what they're calling August 6th, 2024. And with good reason. The global stock market went into freefall. Panic selling gripped investors. The S&P 500, a bellwether for the U.S. economy, recorded its worst single-day drop in over 3 years. The tech-heavy Nasdaq, already reeling from recent losses, took an even harder hit. But it wasn't just the U.S. feeling the pain. European markets tumbled. Asian markets followed suit. The interconnectedness of the global economy meant that no one was immune to the contagion. From Tokyo to London to New York, it was a sea of red. Analysts were quick to draw parallels to the infamous Black Monday of 1987, when markets similarly plummeted. The similarities were striking, but the scale of the 2024 crash was unprecedented in the digital age. Social media amplified the panic, with real-time updates and speculation fueling the fire. Governments and central banks around the world scrambled to respond, holding emergency meetings and press conferences. The Federal Reserve, European Central Bank, and Bank of Japan all issued statements aimed at calming the markets. Experts debated the causes and potential long-term impacts, with some predicting a prolonged recession. Others remained cautiously optimistic, pointing to historical recoveries and the resilience of the global economy. As the dust began to settle, signs of recovery started to emerge, but the scars of this new Black Monday would linger for years to come. Now, some of you might be wondering, what the heck just happened? Why did the market take such a nosedive? Well, let me introduce you to George Soros. He's a legendary investor with a unique theory called reflexivity. Reflexivity is about the feedback loop between perception and reality. If everyone believes the market is going up, they buy more, driving prices higher. It's a self-fulfilling prophecy. The more people buy, the higher the prices go. But it works both ways. Negative sentiment can cause a swift and brutal downturn. That's what we saw on August 6th. Fear spread like wildfire. Soros's theory of reflexivity isn't just academic. It has real-world impacts. Understanding reflexivity can help investors navigate the market's ups and downs. By recognizing the feedback loop, investors can make more informed decisions. So the next time you see the market taking a nosedive, remember Soros's theory. It might just give you the insight you need to stay calm and make rational choices. So, what triggered this sudden shift in sentiment? There's no single answer, but one word keeps popping up. AI. Artificial intelligence. It's the hottest thing since sliced bread, right? Companies are pouring billions into it, promising to revolutionize everything from healthcare to transportation. And investors have been gobbling up AI-related stocks like candy. But here's the problem. Hype can only carry you so far. At some point, reality sets in. Investors started questioning the lofty valuations of AI companies. Were they really worth the astronomical sums being thrown at them? Doubts crept in. And once the doubts take hold, watch out below. We've seen this pattern before. Remember the dot-com bubble? The housing market crash? History has a way of repeating itself, especially when exuberance outpaces reality. Seasoned investors know that when something seems too good to be true, it often is. The debate rages on. Is AI the future or just another bubble waiting to burst? Fundamentals matter. Earnings, revenue, and real-world applications are what ultimately sustain a company's value. As the dust settles, investors are becoming more cautious, scrutinizing every detail. Diversification is key. Betting everything on one trend can be risky. In the end, it's about balancing dreams with reality and making informed decisions. Only time will tell if AI is the dream that changes everything or just another delusion. Now, let's hop across the Pacific to Japan. The land of the rising sun has been stuck in an economic rut for decades. Sluggish growth, deflation, you name it. One of the ways Japan has tried to stimulate its economy is through ultra-low interest rates. We're talking about near zero, folks. This has created a lucrative opportunity for investors engaged in something called the carry trade. Here's how it works. Investors borrow money cheaply in Japan, then invest it in higher-yielding assets overseas, like US stocks or bonds. As long as the interest rate differential holds, they rake in the profits. Sounds like a sweet deal, right? Well, it is, until it isn't. To understand Japan's current situation, We need to look back at the 1980s when Japan experienced an economic bubble. The bubble was fueled by speculative investments in real estate and stocks. But when the bubble burst, it led to a prolonged period of economic stagnation. Since then, the government and the Bank of Japan have tried various measures to revive the economy. These measures include quantitative easing and massive stimulus packages. However, the results have been mixed, with some successes and many challenges. Japan's economic policies also have significant implications for global financial markets. International investors closely watch Japan's moves, as they can influence global investment strategies. The future remains uncertain, but one thing is clear. Japan's gamble continues to be a critical factor in the global economic landscape. And that's where August 6th comes in. Remember the Fed's interest rate announcement that had everyone on edge? Well, it turns out that central banks around the world, including the Bank of Japan, are starting to get worried about inflation. They're hinting at raising rates sooner than expected. And what happens when interest rates rise? The carry trade unwinds. Investors dump their foreign assets and rush back into their home currencies, like the Japanese yen. The yen surged in value, catching many investors off guard. Those who had borrowed yen to fund their carry trades were forced to sell their foreign holdings at a loss to repay their loans. This triggered a domino effect, sending shockwaves through global markets. Analysts were quick to point out the volatility that ensued, with many scrambling to reassess their positions. Central banks had to convene emergency meetings to address the sudden market turmoil. Comparisons were drawn to previous market crashes, highlighting the severity of the situation. Investors and financial advisors were left in a state of uncertainty, trying to navigate the turbulent waters. The global market indices fluctuated wildly, with news anchors reporting live updates and financial experts giving their take on the unfolding crisis. Headlines about the yen's surge dominated financial news, as traders reacted in real time to the rapid changes. As the clock ticked, financial analysts worked late into the night, trying to make sense of the chaos before the stock market's closing bell. The global market overview painted a grim picture, with experts discussing the potential long-term implications of this financial upheaval. Central bank officials made statements to calm the markets, but the financial news ticker continued to show the intense scrutiny investors were under. Eventually, financial charts began to stabilize, and traders grew cautiously optimistic as news headlines hinted at a potential market recovery. So, what's an everyday investor to do amidst this market mayhem? First and foremost, don't panic. Remember, the market has a long history of ups and downs. This too shall pass. Second, diversify your portfolio. Don't put all your eggs in one basket, especially one labeled AI or carry trade. Third, if you're feeling overwhelmed, don't be afraid to consult a financial advisor. They can help you navigate the choppy waters and make informed investment decisions. And finally, be wary of the hype. Just because everyone and their grandmother is talking about a particular investment doesn't mean it's right for you. Do your research, ask tough questions, and don't get caught up in the frenzy. It's crucial to stay informed. Keep up with the latest financial news, but don't let it dictate your every move. Balance is key. Consider setting long-term goals. Short-term market fluctuations can be unsettling, but having a clear vision for your financial future can help you stay the course. Remember, investing is a marathon, not a sprint. Patience and perseverance are your best allies in times of market volatility. Lastly, trust in your strategy. If you've done your homework and made informed decisions, have faith in your plan. The market will have its ups and downs, but a well-thought-out strategy can weather the storm. Stay calm, stay informed, and stay the course. This too shall pass, and you'll come out stronger on the other side. Black Monday 2024 was a stark reminder that markets are unpredictable, but it also underscored the importance of a sound investment strategy. Diversification, risk management, and a long-term perspective are your best defenses against market volatility. So, buckle up, stay informed, and remember, in the words of the great Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. The events of Black Monday 2024 sent shockwaves through the global economy. Investors around the world were caught off guard, leading to a cascade of sell-offs and panic. However, those with a well-diversified portfolio and a clear investment strategy were better positioned to weather the storm. It's crucial to understand that market downturns, while challenging, are also opportunities for growth. History has shown that markets tend to recover over time, often emerging stronger than before. By maintaining a long-term perspective and staying committed to your investment strategy, you can navigate through the volatility and come out ahead. Remember the wisdom of seasoned investors like Warren Buffett, who emphasize the importance of patience and discipline. As the market begins to stabilize, opportunities for growth and recovery will present themselves. Stay informed, stay patient, and stay the course. The storm will pass, and those who are prepared will thrive.